Hey guys, welcome back to my YouTube channel Simplified Accounts. मेरा नाम है शिवांश गुप्ता and today I will discuss about the classification of mutual funds. You can also check out my previous video about mutual funds where I discussed about the basics of mutual funds. The link is in the description. And if you are new to the channel, then please subscribe and click on the bell icon to enable notification, and do check out my other videos. Let's start. Classification of mutual funds. The information contained in this video is for only educational and awareness purpose related to mutual funds and shall not be treated as recommendation from my side for investment in mutual funds. Investment in mutual funds are subject to market risk. Please read the document carefully before investing. Some of the important key terms to know in mutual funds are NAV or net asset value is the unit price of a mutual fund scheme. Since market value of securities change every day, so the NAV also varies on day-to-day basis. The NAV is calculated market value of securities of a scheme upon total number of units of scheme on a particular date. A new fund offer or NFO is a first time subscription offer for a new scheme that has been launched by an asset management company. It means with the help of an NFO, the fund house raises money from the public to purchase securities such as equity, shares, bonds, and so on in the market. Sensex. Sensex stands for Stock Exchange Sensitive Index, and it is the stock market index for BSE. As we are aware about the Sensex, Sensex is being comprised of 30 of the largest and most actively traded stocks, whereas Nifty 50 stands for the National Stock Exchange 50, and it is a stock market index of NSE. The Nifty 50 is being comprised of 50 of the largest and most actively traded stocks. Next one is AUM or Asset Under Management is the total market value of investment managed by an asset management company, AMCs. Classification of mutual funds on three bases. First is based on structure, second is based on investment objective, and third is based on the investment style. Based on structure, there are three types: open-ended funds, close-ended funds, and interval funds. Whereas on the basis of investment objective, there are debt funds, equity funds, and hybrid funds. And on the basis of investment style, there are two, which are passive funds and active funds. Classification based on structure. Open-ended funds. It doesn't have any maturity date, whereas it accepts continuous sale and repurchase requests. Moreover, transactions in open-ended funds are NAV based. Capital is not fixed in open-ended funds, whereas in closed-ended funds, run for a specific period of time, offered in an NFO but are closed for further purchase after NFO. Capital is kept constant in close-ended funds. Therefore, the close-ended funds can be bought only during their launch and can be redeemed when the fund investment tenure is over, whereas in open-ended funds can be bought or sold anytime. Interval funds. It consists of variety of closed-ended funds. Moreover, it is a variant of closed-ended funds. Becomes open-ended at specific intervals. Have to be mandatorily listed. Classification based on investment objective, which consists of three. First is debt fund. It invests in fixed income instruments such as corporate and government bonds, corporate debt securities. It aims to provide regular income to senior citizens. Low risk and low return instrument. It gives up to 4 to 7% returns per annum. Whereas equity funds invest in stocks of different companies. It aims to provide growth and capital appreciation over long term. High risk and high return instrument, as it provides 10 to 15% interest rate per annum. Moreover, debt funds are good for the investors who want to invest in higher rated securities which are less volatile, whereas the equity fund are suitable for investors with moderately to high risk appetites. Last, hybrid funds invest in a combination of stocks and debt securities. The proportion of equity and debt may vary or even same, also depend upon its scheme, and it aims to provide for both income and capital appreciation. It has a moderate risk and medium return instrument. It gives 6 to 10% return per annum. Next is our classification based on investment style. Passive funds replicate a market index, invest in same securities and in same proportion as that of index like Nifty 50, which consists of 50 stocks. No active selection of any sector or a particular stock. Moreover, expenses are lower in passive funds and portfolio is modified every time index composition changes. For example, Nifty 50 based funds modified whenever there is additional or deletion of any stock. Active funds invest in securities and sectors that may offer a better return than the index. Actively manage the allocation to the market securities and cash and incur a higher cost as compared to the passive funds. Thank you for watching this video. प्लीज लाइक शेयर एंड सब्सक्राइब। चलिए मिलते हैं आपसे अगली वीडियो में, तब तक के लिए जय हिंद जय भारत।